So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to the Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to the Daily Call. Today we're going to answer the question, how to protect long call option profits. So there's three ways to technically do this. I'll go through them here on today's podcast. Again, we generally don't suggest that you trade long call options. It's not really a trade that generates high expected overall returns. But if you find yourself in a position where you did, for some reason, feel a little bit lucky and you wanted to trade a long call option, you have some profits in place, how do you basically protect those positions? So the first thing you could do is sell the position. This is pretty simple, actually, and probably my most suggested option to do is just get rid of the position and take your money off the table. So if the market gives you a favorable move and it happened in a short amount of time to where time decay is not ripping the value out of these long call options, then your best choice might be to just simply sell back the call option to close and remove the position. The second thing that you can do is you can then buy a put option. So you could buy a put option. This would effectively turn the position into a straddle, and buying the put option would be a little bit more costly because you have to outlay capital for the put, which would increase your break-even points overall. But again, it could protect you in case you think that the stock is going to make a huge move in the opposite direction. Now, the problem with this strategy is that you basically, like we had said, turn this thing into a straddle or to a strangle, which means that now you are no longer directionally long the security. You're looking for the security to make a huge move in either direction. So yes, it does help protect against potentially the stock going down, but at what cost, right? At what cost do you have to widen the break-even points, outlay capital to buy insurance? The third way that you could do it is you could turn it into a spread. So you could sell a call option above where your long call option is or above where the stock is trading at this time, collect some premium by doing that, and basically turn this position into a bull call spread. Now, this doesn't do much though, because you basically still have all of the downside risk of the call option going down in value. But by selling the call option above where the stock is trading or above where your strike price is, you might capture a little bit of premium to pad some of that downside movement. So again, the real limitation to this one is that if the call option goes up in value from say $100 to $1,000, selling a call option is not going to reduce the risk that that call option then goes right back down in value from $1,000 to $100. So hopefully this helps out. Again, just kind of helping you guys out with different strategies as we always try to do here at Option Alpha. If you have any questions, let me know. And next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.